Dan, tell us a little bit about how Betterment customers are interacting with meme stocks. I want to just move off of this just a little bit. Obviously, Robinhood has been in the news recently, but even going back to GameStop, what do you tell people about that involvement? Because now you have stocks that are obviously trading for people who are, let's say, fundamentally insensitive. I don't know what the word should be, but how do you advise people when stocks start trading at prices that are completely divorced from fundamentals?
One of the sort of key things about meme stocks that we see is that they kind of need to have a community focusing their attention on just that one thing. It's not a matter of being diversified. Everybody needs to focus on GME or a silver ETF, whatever it is, especially if they're trying to do short squeezes. So I think there's some level of, we have to be realistic. People like to enjoy investing. There's some level of gambling tendency in it. And that's okay as long as you keep it kind of under control. As long as you say, I'm going to treat this like Vegas. I'm taking money out. I'm not allowed to take out more than I've taken with me. I'm going to have a sort of set risk budget for it. And as you said, if I make huge returns, great. I should rebalance back out of my speculation pot into my serious retirement goals, etc. That's a little bit what I think we're starting to see over at Betterment, which is that we're over a year now on from the trough, the 2020 March trough, where a lot of people started speculatively trading, looking at individual things. So we've moved out of that kind of like initial novelty area. Now people are a little bit like, you know what, this feels like a job. I've got to manage assets. I've got to look for buys and sells. I probably have an Excel spreadsheet somewhere. So we're starting to see what I would call day trader fatigue, or people saying, you know what, the novelty is worn off, and I want somebody who's going to do this for me. So we're still actually seeing pretty good inflows from new customers and new signups as well.
Yeah, you know, this is a story that's been around for 25 years. Even Jack Bogle, who's probably the person who most influenced the way I look at the world, the founder of Vanguard, admitted that people like to gamble a little bit, and he himself said, if you feel the need to scratch that itch, take a small amount. He might have mentioned 10%, but that seems to be where a lot of financial professionals are gravitating around. If you really feel the need to gamble, you should have most of your money in long-term, passively managed funds. Most people feel, but take 10%. Dan, does that 10% number mean something a lot to you? What I find interesting is exactly what you said, that it's very easy to get in, but devising an exit strategy is very, very difficult. Market timing is extraordinarily hard to do, and generally you lose for the simple reason that you got to be right going in and you got to be right going out. So we all know this, and you've been talking about it for many, many years. And the academic literature is overwhelming that market timing does not work over long periods of time. So do you think, I like that line you used, investor fatigue. Is that starting to get through to the new investors that are out there?
Yeah, I think we're seeing something kind of interesting. So, if you think about life cycles of people, young people, like 16 is when you learn to drive a car or something. And I don't know, maybe like 30 is when you buy your first house. What we saw is the pandemic in 2020 kind of smushed a whole generation of people into learning about investing in the same time, namely about April, May of 2020. And the academic literature says this often happens. People come in, they want to get their hands dirty, they want to learn about investing, and they do it. They manage their own portfolio in stocks that they're familiar with, retail name, consumer-focused names, things that make them feel comfortable with getting invested. After they do that for about a year to 2 years, they start to learn that, you know what, day trading is work. It takes attention. Sometimes it's stressful. And I don't know that I want to do it anymore. So you generally see this sort of fatigue kick in somewhere between a year and 3 years, with people realizing that, number one, they're not beating the market by that much. And number two, it's a job and they don't want to have a spare job.
Yeah. One of the things that amazes me, Dan, is the old Wall Street. I've been 31 years at CNBC. I'm down here at the New York Stock Exchange 24 years. Old Wall Street tends to poo-poo the Reddit traders and the Robinhood crowd. And I do not understand that attitude at all. To me, I look at Robinhood, I see 22 million accounts in a few years. That's an amazing number, 22 million. Schwab has 33, 34 million. Vanguard probably has 37 or 38, and BlackRock probably the same number. But they've been around for decades. 22 million accounts in a few years. Now Wall Street says, oh, but there's not much money in the accounts. And I say, that's not a good attitude. Those people are going to grow, and what you want to do is encourage them to stick around and educate them. So, what you're saying, Dan, makes an awful lot of sense to me. I just hope that they stay around, because you know there's going to be a downturn at some point. They're going to lose money. So will they just throw up their hands and say, oh, it's all rigged, Wall Street's rigged? But it's not rigged. It's just the market turned down. And hopefully they'll stay around. So I'm cheering for Robinhood. I really want those 22 million, not for the company, but those new investors. I want them around. They're a really valuable source of energy for the market. So Dan, I hope you're going to be able to be a factor in making those people stick around.
We'll take them and upgrade them.
Yeah, okay, very good.